We will now look at practical example 3 of chapter 10, which is the closing transfer journal entries. In order to be able to do these journal entries, we need the post-adjustment trial balance that is on the left-hand side of the screen. And this is the trial balance we prepared in practical example 2. Just to recap, when we looked at the theory slides, here is a summary of the closing transfers that need to be done. All the accounts that go off to cost of sales is opening inventory, purchases, returns, any costs on purchases, and closing inventory. When we did the adjustments, we already did the closing transfer for opening inventory, and we did the adjustment for closing inventory. So opening and closing inventory are already sitting in cost of sales. Cost of sales is then closed off to the trading account, as well as sales and sales returns. The sales and sales returns gives us net sales minus cost of sales gives us the gross profit for the year. This gross profit is then transferred to the profit or loss account, as well as any other income that the business may earn, as well as all the operating expenses are all transferred to the profit or loss account. When this account is balanced, it then gives the profit or the loss for the year, depending on whether it's a debit or credit balance. That profit or loss for the year is then transferred to the capital account, and the last closing transfer is then to transfer drawings to the capital account. So these are the closing transfers that we are going to do now. We therefore start off with our purchases and freight on purchases. And once again, as I said, we need the post-adjustment trial balance because here we have all the income and expense accounts with their final amounts that need to be closed off. So we look first at purchases and freight on purchases because they both have debit balances. In order to close them off, we then credit those accounts and we transfer it to cost of sales. So purchases and freight on purchases now have zero balances. The next one that we do that also affects purchases is the purchases returns. It has a credit balance, so to close it off, we then debit the account and we credit cost of sales. Then we need to go and close off cost of sales to the trading account. So we need to see what transactions have affected cost of sales. In the post-adjustment trial balance, we already have the opening inventory and the closing inventory that we did in practical example 1. We already have them transferred to cost of sales. That gives us a balance so long of 2,000 Rand on the debit side. We debited cost of sales with 14 and we credited cost of sales of 12. If you balance that, you have a debit balance of 2,000 Rand. Then we also have a debit amount against cost of sales of 35.5 and we have a credit amount of 2,000 Rand. So we're now sitting in cost of sales with a debit amount of 2,000. We need to add that other debit amount that was transferred, the purchases and freight on purchases, so 2,000 plus 35.5, and then we deduct the credit amount of 2,000 Rand that was from purchases returns. So that gives us a balance of 35,500 Rand. So if we had to balance the general ledger account, it would result in a debit balance of 35,500 Rand, 2,000 Rand plus 35,500 Rand on the debit side, 2,000 Rand on the credit side, ends off with a debit balance of 35,500. So to close off cost of sales, we therefore need to credit the cost of sales and we need to debit trading account. So cost of sales has now been closed off to trading account. Just take note that trading account does not have a financial statement indicator because this is a general ledger account that does not appear in any financial statement. It is a temporary account that we use to calculate the gross profit and it is then closed off. In other words, there is no more balance in the account and we take whatever balance there was to the profit or loss account. We now have all the cost of sales items in the trading account. The next items that must go to trading account are sales and sales returns. Sales has a credit balance. To close it off, we need to debit the account, and we transfer it to trading account. Sales returns has a debit balance, so to close it off, we need to credit sales returns, and we transfer it to the trading account, therefore debit trading account. We now have all the necessary items in the trading account in order to calculate gross profit. We have sales, sales returns, and the cost of sales. So we balance the trading account now in order to see is there a gross profit or a gross loss. We therefore need to look at all the transactions, the journal entries that affect the trading account. The first one is the cost of sales that has been transferred, and then the next two are the sales and the sales returns, which represents net sales. So if we go and balance this trading account, we look at the amounts on the debit side. In total on the debit side, we have 38,500 Rand in the trading account, and on the credit side, we have 46,000 Rand. Credit side therefore has the larger total, which results in a credit balance. If there's a credit balance in the trading account, it means that the business made a gross profit. If it had a debit balance, it would have been a gross loss. But now our credit side is more than the total of the debit side, 46,000 Rand minus 38,500 Rand. That is that calculation here. In order to calculate the gross profit, the credit amount of 46,000 Rand minus the two debit amounts of 38,500 Rand, that gives us a gross profit of 7,500 Rand. And as I've already said, the credit side has a larger total, therefore it is a credit balance. In order to close off the trading account, we therefore need to debit the trading account, and we transfer that to the profit or loss account. So that is the next step in our closing transfer. All the accounts that go to profit or loss, the gross profit from the trading account, other income if there are any other income items that the business earns, and all the operating expenses. So we now got the gross profit in the profit or loss account. Once again, same as with the trading account, the profit or loss account is a temporary account that is only used to calculate the profit for the year. It does not appear in any financial statement. So we've got the gross profit in the profit or loss account. Then we go and have a look at all our expense accounts. So we have salaries and wages, water and electricity, depreciation, and credit losses. These all have debit balances. To close them off, we need to credit the accounts. And we transfer the total of all these expenses to the profit or loss account. And that total is then, in this case, 8,999 Rand. So our gross profit is in the profit or loss account, all our expenses are in the profit or loss account. Last item is then any other income that may be earned by the business. As you can see, there are two income items that have credit balances. In order to close them off, we need to debit those accounts, and we credit then the profit or loss account. So now in the profit or loss account, we have our gross profit, we have all our other income items, and we have our operating expenses. We now balance this account in order to calculate the profit or loss for the year. How do you do that? Just by a mere calculation, because we're not preparing general ledger accounts. Have a look at the journal entries that affect profit or loss. There's the gross profit. There's the total of the expenses, and there is the total of the other income. So now you look at the total of the credit amounts, which is roughly 11,600 Rand, the total of the debit amounts, which is just the one amount, just under 9,000 Rand. So then obviously the credit side of the profit or loss account has the larger total, 11,640 Rand, compared to the debit total of 8,990 Rand. Because the credit side has a larger total, there is therefore a credit balance in the profit or loss account, which represents a profit for the year. Because we have a credit balance in the profit or loss account, to close it off, we need to debit it. So the amount that then is the balance in the profit or loss account is 2,650 Rand. It is the two credit amounts minus the one debit amount. That gives us a credit balance of 2,650 Rand. In order to close it off, we debit the profit or loss account and we transfer it to the capital account. So we credit capital with that profit for the year. Capital is an equity item, so it appears in the statement of changes in equity. The last closing transfer we do is drawings. As you can see in the post-adjustment trial balance, it has a debit balance. So to close it off, we need to credit drawings and we transfer it to the capital account. Both of these are equity items, so they appear in the statement of changes in equity. If we go back to our slide, we have now done the last transfer, which is to transfer the profit or loss for the year and the drawings to the capital account. So we have completed all the closing transfers for this example.